Hello, everyone, and welcome to this Nadex webinar, The Basics of Nadex Knockouts. My name is Todd Rich. I am head of education and part of the business development team here at Nadex. If you haven't joined our sessions before, I'll introduce myself in a second. But we have a good session, and we've got a pretty good group of folks on right now, and I know more people are going to be joining because everyone comes in within the first minute or two. I would like to go through a couple of quick housekeeping items before I get started. Number one, this is an interactive session. If you've got questions as I go, please, there's a question mark with a little red circle and a 1 in it on the right-hand side of your platform. If you click that, the little question mark with the 1, it is where you can type in questions. As I go, please put in questions. I will do my best to monitor all of those questions. I will often see those and then simply incorporate them into what I'm saying so I can answer them as we go. I might call out a question. And the truth of the matter is, if you have a question, there's a high likelihood that somebody else has a question as well. So I just want to make sure that you see that and that you make sure that if you've got questions, please fire them away. I will do my best. The second is this is being recorded. I will show you where you'll be able to find it, both on the Nadex website as well as the Nadex YouTube channel. So you'll be able to go back and review this at your leisure if you're not able to join for the whole day, or you'd like to go back and look at specific sections individually. All right, so that is the extent of my housekeeping items. Let's get into it. Before I start, I do need to share this disclaimer that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say today as a buy or sell recommendation. I'm doing this for your education purposes. And that will become abundantly more clear because a good part of today's session will be what I like to call an off-roading sessions, where I will jump into the platform and I'll do a very practical demonstration of knockouts. And when I'm doing that, I'm not making buy or sell recommendations. I'm simply clicking around and showing you how it works. All right. Now, I mentioned I would introduce myself quickly. Again, my name is Todd Rich. If you haven't joined, I'm going to remind or emphasize we do a morning market movers session every morning. I do that with Brian Caprice from Keep Trading Simple. We do it at 8:45 a.m. Eastern, 7:45 a.m. Central. It's on YouTube. We live stream it. If you aren't familiar with those, I will at the end when I do the off-roading, I'll actually show you where you can find those as well. If you can't make those are also recorded. But it's a great way to start your trading day with a brief, usually 10 to 15-minute summary of what's transpired overnight, what's moving the markets today or that particular day, what are the major headline news, are there economic reports, and then we actually jump into charts and do a little bit of technical analysis and sort of get everyone ready for the trading day. It's we've got a really great group of folks who join every day. It's a fairly significant group, and it's getting bigger. So I would encourage you to hopefully join those. But if you haven't joined them before, I did join Nadex in 2019. I have been in the financial services sector for decades now. I did start trading on the floors back in the 90s. And I migrated off the trading floors and went to work for the exchanges. I went to work for Eurex, which is owned by Deutsche Börse. It's a very large global futures exchange out of Frankfurt, Germany. And then I moved into the equity options space with Boston Options Exchange. We rebranded it Box, the New York Stock Exchange. And when I left the New York Stock Exchange, I went into the retail space at E-Trade. And from E-Trade, I came over to Nadex. I did grow up in California, and I did get both my BA and my master's from UCLA. All right, enough about me. Let's talk about what we're going to talk about today. And it's a relatively short agenda, but there's a lot to discuss. I personally really like knockouts. I think they are our most intuitive and user-friendly contracts. It's just that everyone comes to Nadex because of binary options. If you're not familiar with binary options, I did a session last week on that. I'll show you where you can find the recording. But I really like knockouts, and I think it's a great way to trade the market with defined risk, and we'll get into all that as well. But I am going to talk about who is Nadex briefly, and then we're going to talk about knockouts, how they work, the risk and reward of them, the capital requirements, how much money does it take to trade a knockout, and these were cleverly designed, and we'll get into that whole concept. And then, as I mentioned, it's a very practical demonstration. I will show you. My mom is from Missouri, or Missouri, if I'm going to pronounce it right, the show me state. I will show you. So quickly, who is Nadex? Nadex is simply an acronym. It's an acronym for North American Derivatives Exchange. But the reason I like to bring this up is a lot of people come to Nadex because of knockouts. And I really want, I mean, not binary options, I'm sorry, binary options. And then they find knockouts. And then the thing is, with binary options, there are plenty of unregulated exchanges out there, and they have all these challenges. Nefarious behavior happens in that space, particularly with offshore exchanges where there's no recourse if they do something goofy with your account. All of that, none of that applies to Nadex, because we are a proper regulated exchange. We are regulated in the United States. We are regulated by the CFTC, the Commodity Futures Trading Commission. It's the same regulator that the Intercontinental Exchange, ICE, reports into. They own the New York Stock Exchange, or the CME, the Chicago Mercantile Exchange, or the Chicago Board of Trade. All of that, we all report into the same regulator. We have to adhere to all the rules, laws, regulations, principles of the United States, and we have regulatory oversight. So any of those goofy things that you hear about offshore providers, particularly in the binary option space, that doesn't apply to Nadex. We are a proper regulated exchange that was designed for the retail trader. And this is what I really like about Nadex and why knockouts are so cool, is when I say we have contracts designed for the retail trader, that is, we have a low cost of entry. You do not need thousands of dollars to access price action in the markets. You can do so with small quantities of money. And what's really cool is that all of our contracts, it doesn't matter whether you're trading binary options, knockouts, or call spreads, everything's got very clearly defined risk. So there are no surprises. You know what you're getting into before you enter a trade. And traders are coming to Nadex specifically to look for short-term price action in the markets. So with the volatility that we've had lately, there has been a lot of opportunity in the markets, and particularly with Nadex markets, to do so in a defined risk environment, so that you don't run the risk of losing everything that you've got, or blowing out your account, or you know exactly what you're getting into before you enter a trade. And at Nadex, there simply are no such thing as maintenance margin calls or any of that. You know what you're into before you get into a trade, no surprises. All right, now, here we go. Nadex knockouts. So first, let's define them. A Nadex knockout is a contract. And that contract will have a price, and it will trade within a set price range. All right, that price range, there's two levels in that price range. There's a low price level, which we call the floor, and there's a high price level, which we call the ceiling. So when you get into a trade, you're going to see a Nadex knockout. It's going to have a floor, and it's going to have a ceiling. And the price of the contract will move and trade between the floor and the ceiling. Now, here's what's cool about Nadex knockouts. Unlike binary options, and if you're not familiar, but you're trading the probability that the contract will be true at expiration, or unlike that, with the knockout, you are trading a delta 1 product. Now, that's a very fancy word, and now you'll know what it means. It means it moves right in line with the underlying. So whatever the underlying is, whether it's the S&P 500 index, or foreign exchange, or a commodity like gold or oil, and our underlying markets outside of FX are all based on the futures contract, they'll move directly in line. There's no volatility component. There's nothing to interpret. If I'm trading gold and it's at $17.50 an ounce, the price of the the knockout will be 17.50. You're trading it right in line with the price of the underlying. And just like any other market, if you think it's going higher, you buy it. Now, if you think it's going lower, you can sell it. Now, I know that's a little, for some people, they don't understand, how can I sell something that I don't own? Well, this is the nature of it being a contract, is you're not actually, if I sell a gold contract, I'm not physically selling gold. I'm trading a contract. I'm simply taking a short or bearish position, and I can do that, and I can sell it, hoping to profit if the price goes down. Right. So just like you can buy it if you think the price is going up. That is a knockout. It is a simple, straightforward. You're buying and selling the price of the underlying, and it will move directly in line with the underlying market, and it will trade between the floor and the ceiling. It has a predetermined set range before you get into the trade. Now let's talk about how knockouts work. And this is why they're called knockouts. Now, a knockout will ultimately settle or expire in one of two ways. Now, by the way, I did just get a question, and this is really important. Can you explain time decay on a knockout? And the answer is there is none. That is the nature of it being a Delta 1 product. There is no time decay on knockouts. With call spreads, and if you come to a call spread session, there is time decay. With binary options, there is time decay. With knockouts, there is no time decay. You are trading the price. The price is the price, and it will simply move directly in line with what's happening to the underlying product. That is why I love knockouts. There's nothing complex to understand. You're simply taking a bullish if you buy or bearish if you sell position on the underlying market. You buy or you sell, and it trades between these two ranges, the floor and the ceiling, until one of two things happens. Now, the first is a price triggered settlement. If the underlying market for that product touches the floor or the ceiling, you are knocked out of the trade. That is why they are called knockouts. They will instantly settle if they touch the floor or the ceiling. So if you buy a knockout and it goes up to the ceiling and it touches the ceiling, you're knocked out. Great. You bought it and it got knocked out at a higher price. Trade is over. You are out. If you buy it and it goes down and touches the floor, you're knocked out. That's it. If it once it touches either the floor or the ceiling, the contract settles. That is the end. All right. Now, the other way a Nadex knockout will settle is by time. And we're going to get into this because every knockout initially is set up as a weekly contract. But the question is if it gets knocked out, if it touches the floor or ceiling, what happens if it doesn't touch the floor or ceiling by the expiration time? And in that case, there will be a settlement price at the end of the week. So in the end, a knockout, you're trading a product. It is directly in line. You're buying it or selling it. The price goes up or down. If it touches the floor or ceiling, you are knocked out of the trade. If it doesn't touch the floor or the ceiling by the end of the week, it will settle and there will be a time triggered settlement. All right, so let's go through some examples of these on how they actually work. Now, as I mentioned, each knockout initially has a duration set for 1 week. And because there is no vega, there's no volatility component. There's there's no time decay. There's no time decay. You're trading a Delta 1 product. It sets up. The price is going to be the price as it trades all week long. Now, during the course of that week, there will be 4 knockouts initially. Now, I am going to go through why we have 4, and it has to do with risk and it has to do with money, and we will go through those concepts. Let's pin that up to the side. But we have 4 knockouts, and as the week goes on, in the event a floor or ceiling is touched on a particular knockout, that knockout is settled and then a new knockout will be listed. So generally, you'll have 4 unique knockouts to choose from at any given moment in time. And again, there is a reason why we have 4, and we are going to go through that. So let's walk through an example. And I'm going to show you an example, and it's kind of easier. It's easy to see. And then when I get over to the platform, you'll go, I get this. As I said up front, this is probably the most intuitive product we've got. They just have these fancy words. And once you see it, you go, that's the easiest thing. I totally get that. And people love these once they start to see them. So here's an example of gold. And at the beginning of the week, gold I picked the number 18.20 an ounce, and we put 4 knockouts in. And the way we do it, the way we calculate a knockout, is we take the current price, and then we put a floor down a little bit, and we put a ceiling up. And then we create another knockout with the floor a little bit lower and the ceiling a little bit lower, and a third knockout and a fourth knockout. Now the ranges, so this is gold, you can clearly see there's a 50-point range between the floor and ceiling. For each product, the range is going to be different. Don't worry about it. We do the math for you, and we show you exactly what could potentially happen. I'm just going through an example, and this is how it works in gold. Now we'll have these 4 knockouts, and you can see that gold at 18.20 at the beginning of the week. Oops, there we go. There we go. Here's the price of 18.20 throughout the week, and there's the end of the week. Now, what happens as the price of gold moves? Now, in this particular example, we're going to have the price of gold, and it starts to go higher. Now, as it goes higher, notice that knockout number 4 has the lowest ceiling. So knockout number 4, that ceiling will get touched first as the price goes higher. Now, when it hits that price level, knockout number 4, you're knocked out, it expires, it settles, and a new knockout, because we're going higher, will be created, so you have a 4th knockout that is then up above. Now let's go through an example if the price goes down for price triggered settlement. And here you got the same 4 knockouts, but as the price of gold goes down, it touches the floor. Knockout number 1 has the highest floor. So knockout number 1 having the highest floor, that's the first one that will get knocked out. That contract settles, and because we're going lower, we'll create a new knockout down below. All right, so that is how you'll see knockouts get created, so that you generally always have 4 knockouts. And again, there are 2 reasons why we offer a variety. I'll say it again, it's risk and money, and we are going to talk about that. Now let's also talk about, I mentioned earlier, there's 2 ways that these knock out, or that they settle. Price is how you get knocked out, and then there is a time triggered settlement. Now with a knockout, they are considered variable payout contracts. And all that means is your potential profit and loss will be determined by where you bought or sold a contract and its final settlement value. Now, its final settlement value could be a floor or a ceiling, or it could be at the end of the week, all right, by time. So here's that same example, with gold. Gold goes up and down all week, and at the end of the week, there were 4 contracts, because we'll know there'll be 4 at the end. And at the end of the week, if these knockouts, when they haven't been knocked out, there will be a settlement time at the end of the week. There will be a settlement price, and your profit or loss will simply be the difference between where you bought or sold and the final settlement value. So that is how knockouts work. When I show you on the platform, you're going to go, I get it very easy, but I think I explained it pretty well. Now, I mentioned there are 2 reasons why we offer 4 knockouts, and risk and money. Let's talk about risk first. And before I even get into risk, I want to talk about the concept of a knockout. And what I really like about knockouts is because they're designed for retail traders, it essentially forces you to be a disciplined trader at some point, because the very nature of the product, baked into the product, is a trading plan. If you don't have a plan with a knockout, you de facto have one. When you start trading knockouts, you know what your maximum risk and your potential reward are before you place the trade. If I'm buying a knockout, or actually the floor and the ceiling, it doesn't matter. The floor and the ceiling are the built-in trading plan levels. They're natural levels to either take a profit or manage your risk. They're going to take a profit or you're going to manage your risk. So whenever you trade a knockout, it does have a trading plan built into it as a profit target or a stop loss. Now let's just kind of talk about that for a second. If you buy a knockout, your natural profit target would be the ceiling. If you buy a knockout and it starts going higher, it will force you to take your profits if it touches the ceiling, right? And that is actually one of the most difficult things for traders is, when do I take a profit and when do I stop my losses? Well, a knockout, it will force you into doing that. If you buy a knockout and you're wrong and it touches the floor, it creates a natural stop loss. You are going to control your risk. I think it's going higher. I buy it. It goes down. I'm wrong. If it touches the floor and you know what you're getting into before you enter a trade, you will get knocked out if it touches the floor and you've stopped your losses. It doesn't matter how low it goes. That is the level. That's where you get knocked out. Now, if you want to take a short position, it's the exact opposite. If you take a short position and you sell a knockout and you're wrong and it goes and hits the ceiling, your stop loss is the ceiling. I think it's going lower. I take a short. I'm wrong. I am going to control my risk, and it'll force me. I will be knocked out of the trade if it goes higher and touches the ceiling. And if it goes lower, I'll be forced to take a profit if it touches the floor. If they sell it and it goes down to the floor, you'll be knocked out if it touches the floor, and you'll lock in your profits. All right. So that is actually, and to be clear, and I just want to make sure I've got this question correct. Hang on one second. Yes, if you take a long position and it touches the ceiling, that's your profit. That is exactly right. You've got that. In fact, here on the very next slide, I think I actually give it to you in the words. If you're buying and so let's first talk about risk. I always like to talk about risk first. If you buy, your risk is the difference between where you buy and the floor. And if you sell, your risk is the difference between where you sell and the ceiling. Now, everyone, and I like to emphasize risk so you can control your risk. On the reward side, your potential profit, if you buy, your potential profit is it goes up to the ceiling. And if you sell, your potential reward is it goes down to the floor. That is why I like knockouts. They're very easy to understand. You see it. We do the math for you on the order ticket so you know what you're getting into, and it's calculated for you, and you can decide, is this risk reward worth it to me? All right, so reason number one why we offer 4 knockouts is risk control. You can control how much risk you're willing to take. All right, that is reason number one. Now, let's talk a little bit more about risk and how traders tend to use knockouts. Now, here's that same example with gold. And let's say I want to go long gold. I want to buy gold, right? And I've got 4 choices to choose from. Now, if you were going to go long, you might choose knockout number 1. Now, why would you want to potentially choose knockout number one? Well, the reason if you're buying, you might choose knockout number one because it's got the lowest level of risk. Now, you know that if it touches the floor, you're knocked out. And if you buy it, and if you buy it, yeah, I'm going to do this in a second. And you buy it goes down, you know you're knocked out. That is your stop loss. So traders will use the different knockouts to control the amount of risk they're willing to take. So this is a very visual way to see it. Now, again, this is assuming you want to go long. Here is that same knockout. Here's where we are right now. There's the end of the week. Here's the floor. We know that knockout number one, the floor was 1810. The ceiling we know was 1860, and here was the buy price. All right, I want to go long. I'm buying at 1820 to visually see what your risk versus reward looks like. Your risk is the red area. All right, that's how much risk you're willing to take, and your potential profit is all of that green. Now, the reason we offer 4 knockouts is you can choose the risk reward ratio that you are comfortable with. Now, this is knockout number one. Now, this might be too close to the floor. You might feel you want to have a little bit more room because you never exactly buy the bottom, you never exactly sell the top. You might want to give yourself a little bit more wiggle room. Somebody might choose knockout number two. If they had chosen knockout number two, the red area will be a little bit bigger. The green area would be a little bit smaller. So your risk reward ratio will change, but you've got to make a determination. How much risk are you willing to take for how much potential profit? And that is reason number one why we offer 4 knockouts, is that you can control how much risk you're willing to take. Now let's go through an example if you were going to take a short position. Here is that same setup with gold, but instead you think gold is going to go lower. Now, if you thought gold were going to go lower, all right, you could sell it. You could take a short position on gold. Now, if you were going to sell, you would, in all likelihood, choose knockout number 4. Now, why knockout number 4? If I'm selling, knockout number 4 has the lowest ceiling. So if it goes up, I stop my losses the soonest. Now, here's that same look, that same graphical representation of risk versus reward. Knockout number 4, the ceiling was 1830, so a much lower ceiling. The floor is down at 1780. Here's that selling at 1820. Notice now, if I'm selling and taking a short, my risk is that red area, and my potential reward is the green area. That's why traders would often use the knockout number 4 if they're going short. Now, again, that might be too tight of a stop. You might want to have a little bit more room. So could you have chosen knockout number 3? And the answer is you could. If you chose to sell knockout number 3, the red area would be a little bit bigger and the green area would be a little bit smaller. Right? So that is reason number 1 why we have 4 knockouts, is so you can choose, or you can manage the amount of risk you're willing to take. Now, the other thing that I mentioned is, how do you choose which knockout and why do you have 4? And it's about the money. All right. Now, capital requirements. What does it cost to trade a knockout? Well, with a knockout, like all other Nadex contracts, they've got very clearly defined risk. And you know what your maximum risk is before you place the trade. When you're buying, your maximum risk is it goes down to the floor. When you're selling, the maximum risk is it goes to the ceiling. Now, your capital requirement, how much money it costs, what you have to put up, is your maximum risk. That is your cost to enter the trade, is whatever your maximum risk is. And once you put that up, once you do a trade, that is your capital requirement. That will never change. There are no margin calls at Nadex, ever. You buy a contract, that's the cost you entered the trade. You knew what it was when you got in because you had to put up your maximum risk. End of story. All right? Unlike other futures exchanges where you could have maintenance margin calls because the price has moved or because volatility has gone up or the market conditions have changed. There's all sorts of reasons why they could choose. Now, the question is, does your risk and reward change as the price of the underlying moves? And your risk essentially doesn't change. Your risk was whatever you initially put on. Your reward and your potential reward, but we're going to get into that because that is a huge question. Because I'm talking, everything I've been couching has been you enter a trade and then you either exit the trade because it touched a floor or ceiling, or because time ran out. So we're going to get to this question, but I love where you're going with it because you're getting it and you're moving a little bit further ahead of me. So with the capital requirements, your capital requirements, whatever you have to initially put in to do a trade, it doesn't matter whether you're buying or whether you're selling. You know what they were before you place the trade. Once you place the trade, that's what it is, and you'll never be required to put more money in to stay in the trade. And that is reason number 2 why we all offer multiple knockouts. Reason number 1 was risk. You could control your risk. Reason number 2, minimize your capital requirements. You can manage your trading capital by choosing the knockout with the least amount of risk. So risk and money. That is why we offer 4 knockouts, controlling your risk and optimizing your trading capital by choosing knockouts, whether you're buying or whether you're selling, that require the least amount of capital for you to put up. All right, so let's walk through an order ticket, and then I've got a really important rule which goes exactly to the question that was just asked about risk reward changing over the course of the week. And so I'm teasing that out there. On an order ticket, and here's an order ticket for the S&P 500. This is clearly a little dated because it was back in June, but we have an indicative price of the S&P 500. At the time, it was trading 39.22. And when I grabbed the example, there was still 1 day and 4 hours left. Notice on the order ticket, we give you the floor and the ceiling. There was a floor down at 39.13 and a ceiling up at 39.63. Now, look at the prices where the market is made. All right, it is made right around the indicative price. The underlying index, 39.22. Notice where the market, the bid is just below that, the offer is just above. And if I wanted to buy, I know that there are 20 contracts that I could buy at 39.22.80. There are 25 contracts if I wanted to sell at 39.21. Now, if I wanted to buy, do I have to trade on these prices? This is the order book as it is at that moment in time. The answer is no. I could try to buy in between. What if I wanted to try to buy one at 39, or I wanted to buy one below? All right, here's me trying to buy one at 39.1840. So I'm putting in a bid just below this. All right, now I could put a bid in between. I could put a bid below. Now, does it mean I'm going to buy it there? No, but if I put a 39.18 bid in, and it were to dip down a little bit, I could buy it. All right, my bid would be sitting there in the order book just below. If I actually bought one there, I know that the most I could lose is $54. That's how much. That's the cost of putting on the trade. I'd have to put up $54. I know the max I can, if I bought it, the max I can make was $446. That is assuming I bought it down here, and then it went and touched the ceiling of 39.63. So this is all calculated for you on the order ticket. Whether you're buying or whether you're selling, it will show you this before you enter a trade. And remember, you can place a bid. I could buy the offer. I could place a bid between the bid-ask spread. I could place a bid down below. I could sell. I could sell on the bid right here. I could place an offer to sell in between the bid-ask spread, or if I wanted to, I could place an offer to sell one higher. It is an order book that anyone can put in whatever price they want. I will demonstrate that as well. Now, an important rule when trading knockouts. This is very important. If I didn't have your attention before, I hope I got it now. Just because there's an expiration associated with the contract does not mean you have to wait until then to see what happened. In fact, just because there's a floor and a ceiling does not mean you have to wait for it to touch the floor or the ceiling. You can choose to exit a position early if you want. You can close the position. So does your risk reward profile change? Well, your risk is your risk, right? You put what you initially got in. If I buy a knockout and the price starts to go up, I'm not risking anymore, but I've got some partial profit. I've got some partial profit sitting out there. If you want, you can choose to exit the position early and sell that position. Now, why would I want to sell it before it went up to the ceiling? And you could sell it because you want to lock in a partial profit. I do not have to wait for it to go to expiration. I do not have to wait for it to go all the way up to the ceiling. I can simply say, I'm willing to take a partial profit. Thank you very much. Now, the other reason you would exit early is to minimize losses. Now, yes, you've got a floor if you buy, or you've got a ceiling if you sell, and you do have a level where you would be knocked out if you are wrong. Do you have to experience, if you're wrong, do you have to experience all of those losses? And the answer is no. If I sell one, I know I'm knocked out if it touches the ceiling. If it starts going higher and I decide, you know what, I don't like that, I don't have to, I can either wait and see if it comes back down. I do not have to wait for it to go all the way up to the ceiling. I could simply buy it back and take a partial loss. So you can take partial profits or partial losses by exiting your position early if you want to. If you want to. Now, that is the slideshow presentation of what we've got. I am going to do a practical demonstration on the platform. Remember, no buy or sell recommendations here. Now, if you've got any questions, please email us, customerservice@nadex.com. If you've got additional questions later, you review this later, you can go to customerservice@nadex.com, email them, they'll answer your question. Follow us on social media. Now, I mentioned at the beginning, we have those YouTube live streams every morning. I would highly recommend that you go to the Nadex YouTube page, subscribe to it, and then you can even set reminders for yourself. In fact, let me show you. All right, this is the Nadex YouTube page. If you go to YouTube, you can search for Nadex and click the subscribe button, and you'll know when new content is put up here if you go to YouTube. Now, we have a lot of different tutorials and content up here. You know, we've even got a whopping 3-minute little video on knockouts just to kind of review it quickly. But you can come up and you can take a look at, we've got plenty of content for you to review. This is also where you'll find, if I go to the videos section, where we will be posting the recording of this particular session if you'd like to come back and review it. Now, also up here in this video section, if you go, instead of just uploads, I can go to past live streams. They're all up here. And you can go back and play any one of our morning market mover sessions. And so if you wanted to hear what we spoke about today, go. Now, today we went a little bit longer. We went 27 minutes. The reason we went a little longer today, markets have been much more volatile yesterday and today. We had a little bit more to talk about. Generally, it looks like we go about 20 minutes. Sometimes we go less, 15, 17 minutes. But you can go back if you can't join us. If I go to upcoming live streams, I can even set a reminder. If you're subscribed, you can set a reminder. I usually keep about a week of these out there, but we do this every morning. Now, we will be doing one tomorrow morning. We won't be back on again until Tuesday because Monday is a national holiday. Nadex will be open for a half a day, and it'll only be certain markets like FX markets that are always open. We'll keep the FX markets open for half a day, but there'll be no equity indice trading because those markets are closed. But you can come and catch us every morning and listen. It's a great resource to find out what the headline news is, what's been going on in the markets and how the trading went overnight, what to look forward to, economic reports, or what might happen during that day, and where you could potentially be seeing volatility in the markets for that day. All right, let's jump over to the platform now. And by the way, usually, and I think I clicked on it earlier. Oh, there it is. Yeah, when you go to the Nadex website, you'll actually see a little box here that you can click on that will, if you want to, if you can't find us on YouTube, if I click on it, I can go, hey, let me see what today's was, or let me see, let me subscribe. It'll help you get over there. It'll be on the left-hand side of our homepage. Now I'm going to go ahead and log in, and I am going into a demo account. So again, no buy or sell recommendations. I am going into a demo environment. If you don't have a demo account, I'd recommend that you give it a shot. Practice trading some. It's a great way to get comfortable with the markets as well as the platform. Now, I am only going to be talking about knockouts here. So I am going to go to the knockouts section. All right, and if there's any product someone would like me to cover today, you can type it into your questions. If you say, hey, can I see the indices? Can I see one of the commodities, oil, gold, nat gas? Can I see an FX market? In fact, it might be kind of fun. The Swiss franc, they did change interest rates. So just for fun, let's take a look at the Swiss franc here. All right. All right, the US dollar, Swiss franc. Let's shrink this down a little bit. I don't want a 1 minute chart. Give me a 15-minute chart. And yeah, you could see that the Swiss raised their interest rates overnight, and we had a fairly significant move in the US dollar, Swiss franc currency pair. Now, this is the beauty of Nadex knockouts. It didn't matter which one of the four I clicked on. We've got all four on the chart for you to find very quickly. If I wanted to cycle through, you can see here's the four different knockouts we've got. Knockout 1, 2, 3, and 4, and you can see them very clearly defined with the blue boundaries around it. Now, if I thought the Swiss franc, the US dollar, Swiss franc were going to bounce and go higher, I might choose knockout number 1. And if I'm on knockout number 1, I might want to buy it. Now I know that if I buy knockout number 1, and let's just look at the price here, the indicative is 96.49, 96.50. Let's say I wanted to buy one at 96.52. All right, right between the bid-ask spread. I'm going to go ahead and place my order. All right, there, we saw my one go in there first. Now, you can see. Now, if I buy one at 96.52, I'm in demo. It looks like I actually just bought it. In fact, I just bought it. I know that I'm risking $23. My floor, if it goes down and touches the floor, I'm going to lose $23. If it goes up and touches the ceiling, I could potentially make $77. If I wanted to have more of these, I mean, let's say I wanted to go long, I could always trade more. I could add to this position. Let's try to buy one at 46, a little bit lower, place an order. I'm trying to buy one more. Notice down here, I'm trying to buy one more. I've already bought one, and I've already down $6. And so you can scale in or scale out if you like. In fact, there I just scaled in. I bought two. All right, now I've got two of them at an average price of $96.49. Okay, so I bought two. Now, what can I do with this? Now, I can wait and see what happens here. One, do I have to wait for it to go up? Do I have to want to all of this profit? No, I can go ahead and say, let's set a profit target. I want a profit target. I'd sell these back. And I know I bought them at $96.49. I bought two of them. Maybe I just want a $25 profit. Oop. Oh, I'm just going to go in increments of two because let's go. there we go, with a one lot. I'm willing to take $25 on one of them. All right, notice I've changed this to one. I want to take a $25 on one, and so I can place an order up above where if it bounced, I placed my limit order. All right, I placed my order. I'm trying to sell one. All right, up at 96.74. All right, and the reason, and all I did was I was setting a profit target on one of these. All right, I set a profit. Now the other thing I could do, if I could decide I just want to get out, I don't like this anymore, I could just simply hit close, and it would send a market order. And right now, if I were to close these two, I could just lock in a $4 loss. I could decide, you know what, I was wrong, sell these back out, get out of here, I don't want this anymore. And I could place an order. And so I'm just going to leave that as it is. Let's take a look now. What if I wanted to go short something? So let's pick a different market. And someone did type in the NASDAQ. This is going to be crazy. I'm really kind of curious what I'm going to see here. I'm afraid of what I'm going to see here. All right, I'm going to put in the NASDAQ. It has been incredibly volatile. Now, as I said earlier, hey, let's say I think I want to take a short position. So I'm going to click knockout number 4. All right, and if I click sell, okay. Now, I think the NASDAQ, you know what? We've sold off. We bounced back. We sold off. I think, the sky is falling. Oh my God, the sky is falling. I want to take a short position. I'm gonna have to move this down a little bit. God, the market keeps dropping. Let's just try to sell one. I'm just gonna place an order. Boy, it is just going down like free beer. Now it's, I'm just gonna put an order in. All right, I did sell one. All right, I don't even know what I did. Let's just see. Where did I sell one? I just wanted to take a short position. All right, here we go. All right, I sold one at 11,194.25. Okay, look at, and it is going down. Now it's going down. Great, great, great. I could just close it and take a $17 profit right now. Woo! But I think I'm going to make more money. Let's set a profit target lower, and I'll buy it back lower. And notice how if I click down here, I want to make a $50 profit. And I'm just picking a number. All right, I'm going to place my limit order out there. All right, now I've got another order. Here we go. I'm trying to buy back my short NASDAQ. All right, down below. And if it drops out, I'll take a $50 profit. So the question is let's just go to my position. What did I actually sell here? I sold one at, and now it's going back up. One at 94. I want to just put the price in just so I can replicate what I did. I sold it at 994.25. All right, there we go. Now, when I sold this, oh, let's turn it to a sell. All right, I sold it at, and now it's going in my face a lot. 190. See, I should have bought it back when I had a chance. There we go. All right, when I sold this at 11,194.25. Okay, when I sold it, I knew I couldn't lose more than $155. All right, and I know that I was trying to make 445. Now, it has gone in my face. It is going up. Do I have to lose all $155? All right. Do I have to lose that? No. If I don't like this position, I could just go ahead and close it, take my 38.50, close it. I just took my lumps. Now, I closed that position for a loss. Now, I was trying to buy it back lower, so I am going to want to delete my profit taking order down below. All right, and there we go. I just traded the NASDAQ. It turned it from a quick profit to a quick loss. That is the nature of trading knockouts. Can I do that? Yes. Do I have to do that? No. But you can trade these back and forth. I simply have, I've chosen contracts where I limit my risk. Now, there will be, now the question is about liquidity. We have market makers at Nadex. So there is with the knockout, there's always going to be a bid and an ask. All right. And it depending on the market, these bid ask spreads are pretty narrow. I mean, you can see as this market ticks around, the bid ask spread can be as wide as 0.25. It could be as wide as 0.75. I mean, it changes, but you're going to have. I mean, there are liquidity providers so that you can exit. And if you place a limit order out there and it gets to that price, believe me, because there's no time value of money in there, as the price of the underlying moves, people are going to trade the knockout because it is a Delta One product. And if this were a knockout, is not going to, it's going to have a price that's going to be around the indicative price. That is the beauty of knockouts. All right. I think I've answered everyone's questions, and I did get a lot of questions. If you've got any more questions, I'm going to give you an opportunity to type them in right now. But really, knockouts are our most intuitive product. I simply am trading the price of the underlying. Let's pick another market just for fun. Let's go take a look and see what's going on in commodities. Okay, gold trading, oil trading higher. It doesn't matter which one I picked because I will find all four of them on the chart. I can always choose, and it makes it very easy for me to see where my floor and ceiling are. If I thought oil were going higher, remember, I'm going to look here, and then I'm going to take a look at my risk reward. If I thought oil were going higher, would I be willing to buy it here? I'm risking 49 to potentially make 101. It's a 150 point spread. If I thought oil were going lower, I would potentially sell this one. Now notice this one, there's very little room. I've only got $10 of risk. In fact, let's just sell this one for fun. I want to see one knock out. If oil's going to punch higher. I am trying to sell oil. Oh, I did sell it. There we go. Okay, so I sold it. I sold it at 36. Notice, let's see what happens here. I'm kind of half hoping that I sell it and that it actually touches the ceiling. Because we'll actually watch me get knocked out for maximum loss if it touches the ceiling. Come on. What was my ceiling? 116.40, 116.45. Nope, we're flirting with it. I haven't gotten knocked out. I was kind of hoping that you would actually see one get knocked out because my short position here would disappear and you would actually see a knockout get triggered. But the only way that's going to happen is if oil ticks a touch higher. It's getting close because the ceiling, did it knock out? No, I'm still in. Darn it. And there, it's actually coming back down. Because the ceiling, is at 116.45. Notice how it has not traded up there. It got so close. It looks like it actually, but it just missed it. Now I've got a short position on, and listen, I thought it was going to go lower. I knew I only had $10 of risk, and and of course now oil's not going to move, but I wanted you to kind of see it. I was honestly wanting to take my lumps. Oh well. I think you get the gist of it. If oil were to touch 116.45, I'd get knocked out. Oops, I was wrong. I'd take my $10 loss. But here I'm just going to sit in it because maybe it won't touch it. And if oil does come back down, I could potentially, at the price I sold it. What price did I sell it? I sold it at 116.36. So yeah, I took $9 of risk for potentially making 141 if oil were to actually turn south here and go lower. All right, with that, I want to thank everyone for joining us. Hopefully you got the gist of Nadex knockouts. Again, it's a Delta One product. You are simply buying or selling the price of the underlying, and you've got natural exit points, a floor and a ceiling. If you buy it, that floor is your stop loss. If you buy it, your ceiling is your natural profit target. If you sell it, the floor is your natural profit target. If you sell it, the ceiling is your natural stop loss. But do I have to wait for it to touch the floor or the ceiling? And the answer is no. Do I have to wait for it to go to the end of the week? No. I can choose to exit the position early if I want to either lock in profits or minimize losses. Again, this was recorded. It'll be available on the Nadex YouTube page. You'll get an email when it's available. And again, I'd encourage you to follow us every morning. Come join us on YouTube, 8:45 a.m. Eastern, 7:45 a.m. Central, and get a rundown of what you might see for that day and where there might be potential hotspots in the markets. Thank you so much for joining, and good luck in the markets, everyone.